What's up everyone, it's Scotty with MoneyVest. In this video, we are going to be talking about the risk dynamics of the markets. I'm going to give you a little bit of an insight into where the risk and reward currently is positioned in the market, because there are certain indicators suggesting that right now extreme fear is back in the market, because the famous extreme greed and extreme fear indicator from CNN that's moved towards the extreme fear level, which I'll go over in just a minute. But there are very specific and subtle other indicators that I also want to point out. There's one specifically that is now hitting to a new all-time low, which is the correlation. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. We'd love to have you on board as a MoneyVest member. And of course, that 16% annual discount does expire in 2 days. So again, you've got 2 more days to take advantage of that. Link's going to be down below. You get access to all of our analysis, all the research reports, benefits, buying alerts, options alerts, trade ideas, everything's going to be included, as well as, again, all the Discord channels. So link's going to be down below, and we'd love to have you on board. So this right here is the chart that I'm referring to, and this is hitting a new all-time low at the moment. Now, this is a ratio, okay? This is not specifically a chart in itself, but this is a ratio of LQD divided by HYG. And I'll go over that in just a minute, but this right here is where we are at 1.39 pre-market, hitting a new all-time low at the moment, coming down to very, very low levels. And of course, this has been on a straight decline in the market since, I would say, at the end of 2020 and beginning of 2021. It's just been selling off. There's been a couple instances where obviously it has spiked quite considerably. This right here, just the circles that I'm pointing out, it spiked really well. But I'll go over what the meaning of this is later in the video, because again, CNN also has this in a separate way, but I'll go over that in just a minute. Now, this right here is what everyone's kind of referring to, right? 25 is where we're at for the fear and greed index. We've been talking about this, but since the NASDAQ is down almost 10% from its recent highs, the S&P is down almost 8% from its recent highs, there's no doubt that investors are starting to become more and more fearful of the market environment right now, which is actually good news for us, because we know that when this actually turns to the left and becomes more extremely feared in the market, then that is usually the best times to be looking at dollar cost averaging. Of course, depending on what you're looking at, what stocks you're looking at, what individual ETFs, stocks, or dividend stocks or whatnot you're looking at, that's going to create that environment for us to look for deals, dollar cost average, and buy and put money to work, right? That's where we are at 25. We're not exactly at sub 20 levels, which would be extremely fearful. And I think if the market does pull back even further, if you do see some more selling pressure, that can lead to this index moving more towards the left, and of course creating even more dire situations in the market. More extreme fear can come in. Now, we've also looked at technicals, right? So S&P 500 breaking down below its 125-day moving average. That is suggesting some fear in the market, and market momentum has been fading because more and more stocks, especially big tech, right? We've talked about Apple, we've talked about Microsoft, we've talked about Tesla and Google and AMD. A lot of these companies have been trading in this downtrending channel for some time, and they're now starting to show signs of even more weakness. They're breaking down below their certain levels, and even the market itself is breaking down below its moving average of 125 days, which again, you don't see that very often. The last time we pretty much saw that was a brief breakdown back in March, where again, in my previous video, I talked about how that was a buying opportunity, right? So in my hands, I can count how many buying opportunities there have been, only 2 to 3 in the last year. And that was obviously in December. October was the best one. December 22 was another one. March 23 was another one. And now we're starting to see, once again, those levels. So again, make sure that you do check out the video from yesterday, because that's going to be very important. This right here is stock price strength, which basically goes over the net new 52-week highs versus the net new 52-week lows on the NYSE, which is New York Stock Exchange. And once again, we're seeing this number below 0%, so that is extremely fearful, because more stocks right now are hitting its new 52-week lows than they are hitting 52-week highs, right? So on a net basis, this number is negative, meaning more stocks are coming down to hit their 52-week lows. And once again, what do you notice? That we are coming down to the same level as we were back in March, this right here back in December, and this right here obviously was October. So very handful of times you actually start to see these deals pop up. And right now we still have a little bit more downside. Maybe we are back down to that same level from back in March. And again, we've talked about some of the other market breadth technicals in our previous video. So all I'm going to say, and again, the objective and the sort of takeaway from these videos really is that don't let these opportunities go to waste, right? These are rare occasions. These are rare events. So start to look for opportunities. And again, a lot of it is going to depend on your circumstances, right? So just because somebody else is waiting patiently to have better deals and they're allowing stocks to come down to their fair values doesn't mean that you have to as well, or you can wait another. It just depends on what is working for you. It just depends on what's best for you. I'm here to point out the risk reward trade-offs offered in the market. It's certainly possible the market sells off even further, right? And the deals become even better than they are today. But that's what I'm here to point out, the risk reward trade-offs, and it's now starting to look more and more and more appealing as the markets are rolling over. This right here is the put call ratio. So this works in a little bit of that inverse correlation. So meaning when this number goes up above 1, and right now it's sitting at 1.08, meaning there's more put options open in the market than there are call options. And you can see, once again, we go back to those specific dates, December 22, March 23, and right now we're not quite exactly as high as 1.2, but we're definitely getting up there, right? And it has been going up there. This right here is where we're at the moment. Yes, it is a little bit of that extreme fear, but I would prefer for this number to be way above 1.2. That basically suggests that more and more people are very, very bearish, and they're becoming more fearful, and as a result, they're hedging that potential downside with put options, and usually works as a contrarian indicator, right? So if more people are bearish, well, guess what? It's usually the time to be a buyer in the market. Now, this right here is what I mentioned as the first chart, which is the junk bond demand, which is still surprisingly at an extreme greed, right? So this is the only one that has not yet flipped from a market sentiment standpoint. This is extreme greed. And what this basically tells us is the spread between junk bonds and investment grade, okay? And this is the same exact chart I had. Actually, might be a little bit different because they're looking at yield spreads and I'm looking at that ratio. So the way this works is, if you come back to the chart that I had, this right here, the way this works is HYG is a high yield corporate bond ETF, meaning high yield, right? High yield is correlated with junk bonds. The only reason why corporations pay you a higher yield is because if their credit worthiness is low, right? They're not that great borrowers of debt. So that's why if they are not that highly rated on a credit rating agency by a credit rating agency, their yields are going to be higher. So high yield corporate bonds are considered high risk, high reward. Whereas LQD in this example, which is investment grade, right? So investment grade, that's also the spread that they're tracking. Investment grade is AAA, right? AA, double Bs or higher, right? These are very, very high credit-worthy borrowers. Think of Apple, think of Microsoft, think of Meta. A lot of these very large big tech companies, even large companies that have a lot of cash with little to no debt, and they're credit-worthy borrowers. So what happens with their corporate debt is that they are investment grade. They are very highly rated. So it's lower risk, but also lower reward, right? Lower risk, lower return on their corporate debt. And what this thing is tracking is it's basically taking into account investment grade, the demand for investment grade versus the demand for high yield. And the fact that this has been selling off, right? So LQD is underperforming. LQD is investment grade. So in other words, investment grade corporate bonds are underperforming relative to high yield junk bonds. So that in itself should tell you that, okay, the demand for high yield government, high yield corporate is higher than investment grade corporate. Meaning the market's risk appetite for corporate debt is still high. That's why that CNN is still showing extreme greed at the moment, because high yield junk bonds are still in more demand versus investment grade right now. So investors are really reaching out for that higher yield, and that demand, that risk appetite is still at an extreme greed level. Now, I don't know exactly when this is going to flip over, because we have seen this, outperformance from LQD in the past. And this was back in, I believe, March of 2023. But we are once again coming down to really low levels, right? So this could be an opportunity to once again look at the markets and wait for when this turns, right? So once we start to see some more extreme fear with this indicator as well, that's going to be another one of those signals from a technical standpoint to be dollar cost averaging, because markets risk appetite this is the only indicator that is suggesting that markets risk appetite is still pretty strong. So if you get a spike here, if the market starts to shift more towards investment grade and becomes more risk averse, starts to get rid of junk bonds, that's going to tell us that, okay, market's playing it defensive now, right? Risk averse is coming back into the market, and that's when we can find opportunities to once again dollar cost average and look for buying opportunities in the market, because a lot of them will be then extreme fear, put call ratio, volatility. Of course, we've talked about in one of our other videos as well. So if you come over to the VIX, it is trading a little bit under 19. I mentioned this in a more detailed analysis in our Discord. I went over everything, 5-6 different indicators to watch. And again, if you want to get access to all that analysis, link's going to be down below, and we'd love to have you on board. But this is where we are with the market sentiment and with the overall risk dynamics. A lot of indicators suggesting fear or extreme fear, with a couple of them, especially this one, suggesting that there is still greed and there's market participants are still looking forward to, buying junk bonds as opposed to investment grade. But there are opportunities coming up, and we have to be ready. We have to be prepared. And I will be looking at dollar cost average here on a lot of these different companies very, very soon. I think there's only a few that are on my radar right now. Enphase is one. PayPal is another, AMD is another, and Amazon is another one that I'm looking to slowly and steadily kind of add more shares at these levels. And certainly the technicals are weak, so technicals do suggest that there may be more potential downside. So I want you guys to be ready, and also take it slow, right? There's no rush. That's what we've been talking about in our Discord as well. Take it slow. There's no rush about it, right? Markets are not going to rally 40% in the next week, right? Take it slow. Take your time. Dollar cost average at a pace you find comfortable, right? That's at the end of the day, you have to DC and you have to look at opportunities and buy at your own pace, right? Don't compare yourself to anybody else, because they are on a different investment journey. So do it at your own pace. Do what works for you. Do what's comfortable for you. And I'm here to help you with any questions as well. So hope you guys enjoyed this video. Find it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. As always, happy investing, and I'll see you all in the next video. Don't forget, there is a 16% annual discount that does expire in 2 days. Happy investing. I'll see you all in the next video.